I decided at a point, maybe it was around 2006 or 7, that I wanted primarily to have my family's savings invested in index funds. The only way that I was going to get alpha was either through leverage and or taking concentrated risk. So that was like really the aha moment for me. I don't want to pay high fees. I don't want to take a lot of idiosyncratic risk, and I want the things to be tax efficient. And when I go through all of those screens, I wind up with broad equity market ETFs. I wind up with some real estate. And that's about it.
This episode is brought to you by Grayscale, your trusted gateway to more than 30 different crypto investment products. You'll hear more about them later in the episode. Nothing said on Forward Guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, everybody, welcome back to another episode of Forward Guidance. And joining me today is Victor Haghani, founder and CIO of Elm Wealth. Victor, you have a storied career, and I'm very excited to have you on this podcast today. Welcome to the show.
Yeah, thanks very much, Felix. Good to be on.
Yeah, likewise, for sure. So, yeah, a storied career, and I think it lends itself really nicely to explore how you got to where you are today and what you do at Elm Wealth by unpacking your career history. I know you're at Salomon Brothers, and then you're one of the founders of Long-Term Capital Management. And I would love to just hear a bit about what your career trajectory has been, and what were some of those big lessons you learned back in the day that have led to where you are today and your perspective on modern day markets.
So yeah, as you say, I started at Salomon Brothers in research out of university, and then I was invited to move out to the trading floor from research. And so I was at Salomon from 1984 to 1993. And then, most of my group went and founded Long-Term Capital Management with John Merriweather, who was the head of our group. And I went to London and ran the London office along with my partner, Hans Hufschmidt, until 1998, when the hedge fund lost 90% of its capital and basically sold the whole portfolio to 13 of the biggest counterparties that LTCM had, and then stayed around for a little more than a year to help liquidate that portfolio and return the capital back, the $4 billion or so of capital back to the consortium of banks that took over the positions. There have been a number of books, a really good Harvard case study written on LTCM. And, there are many, many valuable lessons that came out of that experience. I would say that the one lesson that has been discussed a little bit, but not very much, and which I think is really the strongest and most valuable of the lessons of all, really revolves around the question of skin in the game. And I can speak personally, about how, I was thinking about how much of my savings and my family's savings to invest in our hedge fund. The hedge fund was doing great. I had been familiar with our investment strategies from Salomon Brothers, and even from before the time that I was on the Salomon Brothers trading desk, I saw how successful the trading had been prior to that. So I saw this relatively long history of returns. I understood, where the returns came from in terms of market segmentations and frictions and inefficiencies. And I felt really comfortable that this was a good expected return business. I also realized, though, that there were periods where you could lose a lot of money. And I saw that from our Salomon experience. We had some short periods of time where we lost a lot of money, many multiples of what you would get out from the daily volatility of the positions that we had. So really the question is, how did I decide, for instance, how did I make a decision about how much of my family's savings I would invest in our hedge fund that I was co-managing with, a dozen other partners. And the answer is that at that time, and I was, when we started the hedge fund in 94, I was 32 years old. So at that time, I have to say that I didn't really have a useful or good or satisfying framework for making that decision. So I really just thought about, well, this is the best thing that I'll ever get to invest in. And so I should really want to have about as much of it as possible. Um, that was about the extent of my reasoning. And, I was like, well, I want to, or I think that part of that reasoning was like, you know, I'd like to invest as much as I can in this, subject to, if everything goes wrong, that I will still, have enough savings to not have to change my lifestyle, my family's lifestyle, that, I'm not going to put so much into this that if it all goes bad, that I'm broke, but I'm going to put so much into it that if I lose everything, that my lifestyle could kind of stay the same. And remember, that I wasn't used to having a lot of money, so I wasn't living a super high lifestyle at the time. I was 32, 33, whatever, getting going, had young kids. And as a matter of fact, I didn't even have children at the beginning of LTCM. And my first one came in 94, and then 96 and 99. And so looking back on it, I think that was a very, a woefully partial analysis. That I don't think that the answer is take all of, if you have a really good risk investment, put all of your money into it except that which you need for subsistence, where, what economists mean by subsistence is like that amount of money that if you go below it, you kind of feel like you're broke, that was how I went about it. That I had my subsistence number was like, what would I feel, wasn't, that I would still be like, okay, this is a good lifestyle, but everything else has gone. And, it was only after LTCM that I really, and not right after, it was really some years after that I was reflecting and learning and reading and thinking, that I realized that, there is a really simple risk framework that economists and game theorists and philosophers and all of this had come up with from a long time ago, for thinking about, how do you approach these types of decisions, financial decision making under uncertainty. And the paradigm for that is maximize your expected utility, maximize your, we could translate that into maximize your risk-adjusted wealth, maximize your risk-adjusted return. And if I had thought about that, and if I had done that, and I was aware of it, like I had touched on it in university, maybe it came up, a little bit, over my career in Wall Street, but hardly at all. And it certainly was never something that was ingrained in me or taught to me as an important tool as part of the toolkit. And really, I think that's the biggest lesson that I take away from the whole thing. And I think also it's the most or the least discussed lesson that came out of LTCM was this idea of trying to make good risk decisions. And the book that I co-wrote with my partner, James White, is really devoted to this question of how much. It's not devoted to what we should invest in. You decide what you want to invest in. 99.9% of what's out there is talking about what to invest in, what's good. And that's what everybody's thinking about, is what should I invest in? And what we tried to make the book about was, once you've decided what you like and what you don't like, how do you decide how big to be in those investments with your financial and human capital? So I think that's how I got to where, that's how I got eventually to Elm Wealth and the investment approach that we follow and that we help our clients with.
Amazing. And yeah, I'm curious, as you take some of those personal lessons that you had and you broaden the scope towards just the modern day financial industry that we live in, I think a lot of folks will look at LTCM as a bit of a crossing of the Rubicon moment, and also a time that really spearheaded these ideas of, just high leverage on generating alpha returns, i.e. uncorrelated bets to beta, and just this huge focus on that. And then you extrapolate that to where we are in the modern day and age, which is we have this proliferation of of multi-strat pod shops that really focus on these idiosyncratic pods that are uncorrelated to other pods, and generating those alpha returns. And how do you characterize that transition to where we are in the modern day and age, and especially when you started to relate it towards these focuses of capital being pushed into really pushing these alpha return strategies? Yeah, how do you characterize the situation of the industry in this day and age in contrast to some of those lessons learned back then?
Anybody that was around in 1999 or so would have been surprised that, like, one of the things that people at the time were saying, right, was like, oh, LTCM was too big. We had about $5 billion of capital at the beginning, or just over close to $5 billion of capital in the beginning of 1998. And people would have said, that was too much capital to be doing relative value trades. Or people would say, oh, their position sizes, the leverage that they ran was too large relative to their capital base. So these ideas of, too much capital and too much leverage, I think, were like the two main lessons that people were thinking about in 1999. And, fast forward 27 years later to 2025, well, the capital that's being deployed in these strategies is 2 orders of magnitude bigger. It's 100 times bigger. It's between 10 and 100 times bigger than back then. The economies are bigger, stock markets are bigger, the capital markets are bigger, but the size of the funds being deployed in these strategies is still bigger relative to that. And I think that the amount of leverage in many of these different trades is pretty similar. From what I can tell, that if you look at basis trades, for instance, that somebody running a basis trade, has to run it with a decent amount of leverage to get a good return on capital for investors after expenses, after frictions and all of that. So, I think that it's, I guess it's surprising, to see that those things from back then. Now there's differences, that there's differences in risk management. I think that in general, successful alternative managers have generally followed a policy of having tight stop losses, so that they feel that they want to be in things that are pretty liquid, that they can take them off really quickly, so I think there are adaptations. There are positive adaptations, et cetera, from then to now. But overall, at some high level view, it's like, wow, there's more capital than ever being deployed in these things. And I think the leverage is similar. That the leverage that LTCM had at the beginning of 1998. Sorry, the balance sheet leverage, right, that LTCM had at the beginning of 1998. I think it was low teens. I'd have to go back and remember. I'm not. Don't hold me to that. Well, I'm going to be quoted on that, but don't hold me to that. But it was, it was something like that. It was like low teens. It was probably like 14 or something. Would be my guess, just from recollection. Like, we weren't running a lot of balance sheet risk, and then of course there was a lot of Eurodollar futures. And there were. There were a lot of swaps. I mean, we had swaps that we put on. We did swaps with other people to offset them. We tried to, whatever. But there's a lot of off balance sheet stuff today too. But the balance sheet stuff was not like, our balance sheet was not higher than the balance sheet the balance sheet leverage of LTCM was not higher than the balance sheet leverage of any of the investment banks at the time. So, when people talk about, like, when some of the writers who wrote right after LTCM were writing their stuff, they said, oh, the leverage was so high. Well, yeah, after we lost 90% of our capital, our leverage was, kind of 10 times higher minus the stuff that we had taken off. So, we got to, instead of being 10 times higher, by that time we had taken off, the collapse happened very quickly. I don't know, maybe we unwound half of our balance sheet or something, or a third of our balance sheet. So, our balance sheet was, eight times higher than it was at the beginning of the year, just before the consortium took over the positions, bought the positions, because we had lost 90% of our capital. That was not the target leverage, or whatever, or that was not our leverage constraint, So anyway, I think, again, I don't know that much about what the pod shop, I don't know that much about what goes on today in the alternatives world, but my guess is that the balance sheet leverage is similar, and the off balance sheet is kind of hard. I don't think that the off balance sheet, I don't think that was really that different and such a big issue. That I think that gets exaggerated just because there was a lot of offsetting stuff that we had. That's the way the markets were back then. You would do a swap with somebody, and then you would say, you would even, with the same counterparty, you would just do a new swap to take it off, instead of doing a payment to take the swap off. It was just easier. You did a swap 3 months ago, a 10-year swap 3 months ago. You would do a new 10-year swap today in the other direction, and you say, I've kind of closed out that position, and you would keep track of it. And that was much more the convention at the time. So there was a lot of off balance sheet that didn't represent any kind of real risk to speak of.
If you're thinking about crypto investing but don't want to open a new account or manage keys and wallets, check out Grayscale. Grayscale has been offering trusted crypto investment products for over a decade, with 30 and plus counting, including single asset funds like Bitcoin and Ethereum, diversified portfolios, and thematic exposure to the broader digital asset space. Many of their products are available directly through your brokerage or IRA, just like a stock or ETF. Investing involves risks, including possible loss of principal. For more information and important disclosures, visit grayscale.com. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. My last question on just contrasting these cross currents. At Elm Wealth, you guys talk a lot about risk-adjusted returns and Sharpe ratios, and just really understanding how much outlay of risk am I taking on for some sort of expected return that I'm hoping for. And you mentioned at the onset of the interview this idea of skinning the game, which is a classic Taleb tenet. And I want to pull up one more, is just this idea of fat tails in the markets. And I'm curious on your thoughts in the modern day and age. Do you think we appropriately, based on a lot of the statistical modeling and assumptions that's baked into modern day finance, do you feel like we appropriately quantify the amount of risk that we take on in the market versus the return that we are expected? Or do you agree that we underweight how fat those tails could actually be in these situations?
I think that, it's hard to generalize about how people approach those things. I mean, I think that there's, I think there's very much a realization, of fat tails. I mean, for instance, prior to 1987, prior to October of 1987, options markets really didn't price in a smile or a skew. They priced in neither fat tails, nor did they price in higher volatility from, when equity markets go down. And ever since October of 1987, that's been a feature of options markets. It's just really hard to kind of say how people are thinking about fat tails and skew. I do think that rather than those issues, rather than people missing those issues, I think that what people also, that a lot of people do, which has really big impacts on the market, is that there's a lot of people that come up with their expectations for returns of different assets based on recent history. And this kind of extrapolative return estimation is a very powerful impact on markets. I think that it leads, for people that can understand what other people are doing, it can lead to a lot of alpha, and it leads to very poor returns for people that are basing their future returns on past returns. I think that return chasing is probably the return chasing is probably the thing that hurts investors more than anything, more than underestimating fat tails. And I think that it also leads to the greatest degree of dysfunction in our markets, compared to any other things that are going on. I think that indexing, like the people, the index fund haters out there, like there's a bunch of people like these index funds are terrible. They're ruining the markets, et cetera. I think what's to the extent that there are things in the markets that seem counterproductive in terms of good allocation of resources, I think it's coming from extrapolators and return chasers, more than it's coming from indexing. I think that indexing is relatively benign. I think it's people chasing past returns that leads to some really, poor functioning of the markets.
That's a great segue into, I think, your modern perspective on markets and what you do at Elm Wealth. And you've written a lot about how you went through this transition of obviously running institutional money, working at hedge funds, to thinking about what does it actually look like in terms of personal finance allocation towards markets. And you spearhead this idea a lot of dynamic index investing. So I'd love to just have you unpack, what does that modern approach to markets look like for you in this day and age, and especially in how you reflect in what you do at Elm Wealth?
Sure. Well, the the first thing is that there's not much that's modern about it in a way. Mm-hmm. Although, modern, sometimes modern is, is going back to some, sometimes modern is going back to some, really good, evergreen kinds of ideas. But I think that what we're doing in a way is also very modern in the sense that nobody else is doing what we're doing, which is really rather amazing. So I guess the first thing is, how did I sort of come to be an index fund investor? Before getting to the dynamic part, I decided at a point, maybe it was around 2006 or 7, that I wanted primarily to have my family's savings invested in index funds. And that's what I wanted to be the building blocks of my family's investment portfolio. And, that was about 5 years or so before Elm Wealth got started in 2011. And, as an individual investor, as a non-professional individual investor, which is what I was at that time. I mean, I left the hedge fund world shortly after the whole LTCM thing was like over and transitioned out of. I was an individual investor at that point. And the first thing that I did, around 2001 is I looked around me and saw what people that I respected and liked, and I wanted to follow what they were doing. And what I saw around me was that everybody that was similar to me in terms of having grown up in the financial markets, higher net worth, not super high net worth, but higher net worth. Everybody was like more or less trying to be David Swensen and the Yale endowment. And so that's what I tried to do, so from 2000 until like 2006, I was like, a little David Swensen fanboy or something, like trying to, invest in, an oak tree and this and that, and hedge funds and distress and private equity and venture and all of these things. And, for me, I was sort of getting dissatisfied with it over time, primarily because it just felt like I just didn't feel like I was, that I didn't feel financially free, with the pile of papers on my desk, subscriptions, redemptions, prospectuses, all this stuff. Like it was just taxing on me to be doing a lot of this stuff myself. Investor calls, monitoring stuff, so first I was just really starting to fade on the whole lifestyle aspect of being David Swensen, but on my own. But then like the icing on the cake for me was I was talking to my accountant, David, who had been my accountant forever, terrific accountant. We were going over my tax return for like 2005 or something, or 2006. And I was like, David, I thought that I made I thought that I kind of made, I don't know, like a 9% return on my savings this year. Why am I paying so much in tax? It seems like my tax rate is really high. Like, I don't know, like I was paying, it was like 9% return and my tax rate was like, I don't know, 40% or something. It's like, I don't understand that. Like I didn't have capital gains and, whatever. And, aren't the lower income numbers taxed at a lower rate? And as we went through my tax return for that year, my family's tax return for that year, I realized that a lot of these alternative investments that I was in were very tax inefficient for an individual, like relatively normal taxable investor that I was at that time. And the tax inefficiencies were coming from two places primarily. One place was that there was a lot of expenses. There were a lot of expenses that were coming through as miscellaneous itemized deductions. Right? So, for some of the funds, for some of the things, the management fee was not deductible against income. It was an expense that I couldn't deduct against anything. And there were all kinds of these non-deductible expenses that weren't going against income. And so those expenses all were like needed to be grossed up by like 50%. To be, if I wanted to think about how to take them against a pre-tax income. And then there was also just a lot of ordinary income, non-qualified income, and short-term capital gains that also came through everything. And so, it wound up making my tax rate, much higher than I thought it would be and relatively high. And I was like, wow, if I were just invested in an index fund, I would be first of all, most of my dividends would be qualified. And then also I would be paying long-term capital gains on some deferred basis, like when I wanted to sell those assets or spend the money or whatever. So I would also be getting deferral. And so I was like, wow, I'm going to have like a 20% lower tax rate if I just start investing in long-term investing in equities. And so that was like really the aha moment for me. I mean, I also just felt that I had a lot of idiosyncratic risk in my portfolio, and that I felt like, the only way that I was going to get alpha was either through leverage, through people taking leverage on my behalf, and or taking concentrated risk. And again, going back to my education in finance, in the early 80s, I had learned that idiosyncratic risk is not, in general, at least stock idiosyncratic risk is not supposed to get a risk premium. And so all these things came together, and I was like, all right, I'm going to go into index funds. And then I had this next question. Okay, I'm going to be in index funds. How much? Which ones? How much should I own? How much should I have in U.S. stocks? How much should I have in non-U.S. stocks? How much should I have in bonds, in treasury bills, in REITs? In all these things. And then that kind of led to this idea that it had to be driven by expected returns and it had to be driven by risk. And then that is how we do dynamic index investing. We have a simple expected return driver and a simple risk driver. And that drives over allocations and under allocations to different broad equity markets and broad asset classes that are all available low cost, in a low-cost, tax-efficient format.
If you're thinking about buying crypto, but don't want the headache of setting up wallets or new accounts, Grayscale makes it simple. For over 10 years, Grayscale has helped investors gain secure, regulated exposure to crypto without the hassle of self-custody or opening new wallets. With over 30 investment products, from Bitcoin and Ethereum to diversified and thematic crypto baskets, Grayscale makes it easy to build a crypto allocation that fits your portfolio. Whether you're using a regular brokerage account or investing through an IRA, many of Grayscale's products are available right where you already invest. Investing involves risk, including possible loss of principal. For more information and important disclosures, visit grayscale.com. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. I'm curious where that leaves you in terms of, obviously, this podcast or guidance, it's a show where we have people come on and prognosticate about their macro views and maybe talk about an interest rate trade that they might take on or what have you. And the high level of that is this expectation of trading discretionary macro and those sort of strategies. And I'm curious, how do you net out your perspective on somebody trying to go forth with that? Is it just a fool's game, an ego game? Is there some sort of usefulness to it when you add that into the rest of the portfolio with something like, say, index funds? Do you see any sort of value in those sort of strategies in the day and age that we're in?
I think that short-term macro trading is something that I never was good at. I never was successful at that. I never really did it because I never thought that I would be successful at it as well. But whenever I would think about anything that I would do, as a discretionary macro approach, there was never I never looked back and was like, wow, I wish I had been doing some discretionary macro. I got that right. I got that right. I got that right. No, I just felt, I always have felt that I would have been wrong more than I would have been right. But thankfully, I never really engaged in too much short-term speculative macro. Now, clearly some people seem to be good at it, and I'll talk about that in a moment, what might be going on there. One thing that we did that was really, really fun was we created an experiment that we called our Crystal Ball Challenge. And you can still go to our website and play this thing. I don't know if you've tried your hand at it, Felix, or not.
No, I haven't yet. No.
Okay. So I'm trying to remember when it was. I think it might have been 2 years ago, right around this time of year. We built this game, and I'll tell you what the game is. And we went around to different graduate programs. We had a lot of people play this game for real money to see how they would do. And, we would give them money and then they would play the game and then we would pay them out based on how well they did. So they could, with a half an hour playing the game, they could make, like $100 or something. So the game was that we would show you the front page of the Wall Street Journal from one day into the future, past Wall Street journals, but one day into the future relative to when you could trade stocks and bonds. So we would show you the newspaper from Wednesday morning for the Wall Street Journal, November 15th, 2004, Wednesday morning. And we would let you do trades of going long or short stocks and bonds with leverage as of Monday's close, right? So the Wednesday morning paper would tell you what happened on Tuesday. We would let you trade at the prices on Monday's close, and then your trades would be liquidated at the end of Tuesday, after all of the news that the Wednesday paper told you about had happened. And we let people do this on 15 different days. We kind of had a random approach to choosing the days and getting the newspapers. And we tried to find days where stuff had happened, so it wouldn't just be boring days. So we chose days of employment reports and Fed actions, et cetera, and let people play this. Now we blacked out anywhere where it said stocks up, bonds down, but we left everything else. We just didn't let it say stocks up or bonds down. And we let people play this. So 15 different times when you had a crystal ball, you could actually see the macro news, what that newspaper was going to say, then. And people just couldn't make money on average. People couldn't make money playing that game. So, we had, well, at this point, I think we might have had 100,000 people play the game, but we had about 100 people play it for money at the beginning. And those people really couldn't make money on average. Some people did, some people didn't. And when we've had, now tens of thousands of people have played it since then, we haven't looked at it lately, but, we're still the same pattern. It's very, very difficult. You should try your hand at it. And I think that, it's very difficult. And, one thing that we did after we had kind of run the experiment, we were like, I wonder what would happen if we went to some really successful macro traders and had them play the game. So I think we had like 3 or 4 or 5 very successful macro traders play the game. and they did well. So there's something, like it was really interesting to see the decisions that they made in playing the game. For one thing, I mean, there were a bunch of different things that were different about them than everybody else. So you could trade stocks and bonds. Those guys almost exclusively traded bonds, was one thing. And the other thing they did was that they didn't trade on all the 15 days. They really limited their trades to days when they had a high expected Sharpe ratio, that they were going to get things right. I think that's really made me feel that it's a very challenging thing in general to read the macro tea leaves and to know what the market's going to do. I do think that there's an element that one thing that's like been a tailwind for different macro traders who are doing kind of this general macro trading, but behind their macro trading is a philosophy of cut your losses early, let your profits run. And if you have this framework or paradigm of cut your losses early, let your profits run, that basically lines you up with trend following. And we know that trend following has been very successful, over the last 30, 40 years, or even longer than that. And so, I think that macro traders who have wound up getting some kind of aligned with trend following one way or the other has been a successful approach to macro trading. And it's difficult, because we're programmed to let our losses run and cut our profits early. And it's difficult, it's only some people are wired or are able to function in that way. And, there's a huge literature around this. I don't know if you've heard of the turtles experiment, from, in the Chicago pits. There were the whole, forget the names of all the guys, but there was the turtle experiment where they basically just took people off the street and said, here's your trading, you do whatever you want. But
here's your jacket.
Here's your jacket, but you got to cut your losses early, let your profits run. And the turtles all made a lot of money, and they didn't know anything about anything. They were just off the street. It was like almost like Trading Places, the movie. I think that's a really interesting aspect of the whole thing, as well. So anyway, I don't know. I hope that's a long answer to that question, but
no, I think that's really great, and I think those vignettes are important for people to consider in light of, especially in this day and age. The idea of just these Federal Reserve press conferences. They just feel like the Super Bowl for discretionary macro trading, and everybody gets on top of them. So I think it's really valid to just unpack the validity of these, and I think it does pair nicely into, you didn't mention earlier about your modern approach, which is this dynamic index investing, and I do want to unpack a little bit about how do you derive. You mentioned already like what to buy, but also how much. I want to focus first on the what to buy and how you decide on asset allocation in general. Is it based on these long time fundamentals of something like a Markowitz efficiency frontier and that sort of thing, or how do you think about the composition of a portfolio?
So in terms of the building blocks, right? Like there's millions of things that we can invest in. So we need to have some kind of a screen to narrow things down to an investable universe that's manageable for us. And everybody has to do that in some way, because we can't look at every investment out there and analyze it. So for me, my screen for building a portfolio was, okay, first there are some safe assets. And I want my safe assets to be as safe as possible. I know that nothing can be totally safe. I want them to be as safe as possible. I want them to be low fee, liquid. Right. So that kind of takes me into treasuries, some treasury portfolio mostly. Not to say that treasuries are risk free, but, I think they're as low as risk as anything. And they're relatively tax efficient. They're low cost. They're, it's very liquid and efficient as a low risk investment. So that's that. When it comes to risky assets, I have a screen, that narrows things down for me. The first one is, when it comes to risky assets, I want to own risky assets that should logically pay a risk premium, that should offer compensation for taking that risk of owning that thing. So that means that the risk that I'm bearing has to be like a systematic risk. It has to be an undiversifiable risk. It has to be an ugly risk. It has to be a risk that really hurts when it goes wrong. It should be a risk that the stock market in aggregate is that kind of risk, right? People lose their jobs when the stock market goes down 40%. The price of people's homes goes down when the stock market's down 40%. That's a really nasty risk, and it should earn a compensation. Real estate is another asset that should have a risk premium. Oil should have a risk premium. It's a huge asset. There's $100 trillion of reserves out there that people have to own. It should, if you own it, you should be getting a risk premium compensation for that. So, private businesses should have a risk premium. They're part of the whole equity market. So that's the first screen. It's like I want something that has a valid reason to have a risk premium. I don't want to take idiosyncratic risks that people can diversify away. Not to say that there aren't alpha opportunities in them, but for me, I'm not going to get the alpha. I don't want to take risks that I could diversify or that other people could diversify and shouldn't have a risk premium. I don't want to take zero-sum bets against other people because I bet they're smarter than me. So I just want these systematic risks with as little idiosyncratic as possible. So then the next thing is, okay, I want to be able to estimate the expected return of those things. So it's not enough that they should have a risk premium. I want to also be able to verify that it has a risk premium prospectively. Well, that knocks out a bunch of these great asset classes like oil, right? Like it should have a risk premium, but there's no way to calculate that. It should have a risk premium, but it's impossible. Sometimes it's in contango, sometimes it's backwardated, sometimes it's low, sometimes it's high price. It's just not possible to come up with a satisfying way of calculating its risk premium. 30-year government bonds should have a risk premium. There's inflation risk in them, there's default risk in them, but it's impossible. It's very difficult. I mean, there's ways, but it's very difficult to see to estimate what that risk premium is and for people to agree on it. Now, broad equity markets, actually, you can, that you can estimate it. You could look at earnings yield. You could look at dividends and growth and buybacks. You could put there's different ways, all coming back to where I can make an estimate of the expected return of equity markets, broad equity markets for the next 10, 20 years with some simple metrics. And I can agree with other people about it. I could go to PIMCO and say, hey, what do you guys think? I mean, not that I call them up, but I could say, hey, PIMCO, what do you guys think? And I just say, PIMCO, capital market assumptions, bring it up on my screen. And I see PIMCO has a 10-year forecast for US equities. And I'm like, wow, look at that. That's not too far from mine. And I can go to Morgan Stanley and I can go to AQR and I can go wherever and I can get 20 or 30 of these numbers. I can compare it to my number. And you know what? Everybody's kind of coming up with pretty similar numbers, more or less, because it's possible to estimate the expected return of equities over a long horizon because it's coming from earnings and earnings growth and retained earnings and all of that. So I want to be able to verify, and that takes me to, that really narrows things down. Now I'm into things only that have prospective cash flows. And that leaves me with there's very few assets at that point. Then I'm like, okay, I don't want to pay high fees. I don't want to take a lot of idiosyncratic risk. I said that already, but I'll say it again. And I want the things to be tax efficient. And when I go through all of those screens, I wind up with broad equity market ETFs. I wind up with some real estate, and that's about it. Some REITs, and that's about it in terms of risk premium stories, being able to verify the risk premia, having a good way to verify the risk premia, forward-looking, not backward-looking. And so that gives me the portfolio. And then I have to decide, okay, how much of these things do I want? And that's not so difficult, really, because I've got my expected returns. I have some idea of risk. I have some idea of my own risk aversion. And the portfolio just kind of falls out from there.
I am curious just on that point of sizing, like contrasting it to what I would say is the baseline these days, which is just this classic target date fund style where, maybe you have 60% equities, 40% bonds. And as you get older and closer to retirement, that rebalances into more bonds. Is that like the correct baseline to think about sizing? Or if not, how do you think about portfolio sizing?
Well, I think that portfolio sizing, there's no real concept of a benchmark, really, that the risk that we take should just be a function of expected return, risk, and risk aversion. I don't know of any alternative to that. Like there's no such thing as a benchmark, that 60-40 has no meaning in any way. I mean, it's just, what's the expected return? What's the risk? What's my risk aversion? What's my risk preferences, which could be different at different levels of wealth. I could be one level of risk aversion. Like I'm one level of risk aversion at my family's current level of wealth. If we lost 90% of our wealth, then I would be closer to that subsistence that we were talking about. Or I don't know. I mean, I threw out the 90%. I don't know. Maybe subsistence is closer than that. But wherever it is, as I get closer to subsistence, I'm going to become more risk averse. I should. It makes sense. But whatever. I mean, more or less, here or up 50% or down 50%. My risk aversion as a proportion of my wealth is pretty constant. Now, it's not that easy to think about the whole risk aversion thing. Especially when you're younger, you've got all this human capital and financial capital. Like how do you bring your human capital into your investing decisions? Well, in some ways it's hard. In other ways, it could be easy. It's like, well, I'm just going to be 100% in equities because I've got all this human capital and I don't have much savings. I should, depending on the nature of your human capital. If your human capital is like the stock market, then it's like, well, I'm invested in the stock market. I don't have to be super invested in my financial capital. But those are all the ways of thinking about it. And so, I think in some ways the idea of this static asset allocation, like a 60-40, like some advisor says, you're a 60-40 person. And that there's no discussion of the expected return and risk of the 60 of equities. I think that's like, I don't know. I mean, I don't know. Maybe it's too, maybe I would be too inflammatory saying it, but it's like, it feels like malpractice. I mean, how can you make any investment decision that is not based on the expected return and risk of the things that you're investing in? And 60-40 or target date fund is basically saying that it's saying one of two things. I mean, to be charitable, it's saying the expected return is always the same in the future, or actually what it would be saying is the relationship between the expected return and variance of returns is a constant, always in the future, today and always. And and then making some assumption of the risk aversion of the investor to meet that. But nobody believes that that the ratio of expected return to variance, or that the variance of the stock market to a long horizon tends to be pretty constant, maybe. And to shorter horizons is extremely variable, so it's like, it just doesn't make sense that, you've got this thing that's very variable, the risk, you've got this thing that's very variable, the expected return relative to safe assets, and your asset allocation should be changing. And let me just say that if you just go back historically and look at that, then you see that, yes, the asset allocation should have changed dramatically historically based on expected return and risk. And so I just don't understand. I mean, maybe I'm missing something. And somebody will say, no, this is why 60-40 makes sense. It's not an abrogation of duty on the part of an advisor. It actually makes sense for these reasons. And I don't see exactly what they are. But to me, anyway, it just feels like there is no real benchmark. It's just, what's the expected return? What's the risk? What's your risk aversion? That's the right portfolio for you today. And next month, it could be different. And next month, you might not, next month, your optimal portfolio could be different. And we're not going to move you all the way there because there's going to be taxes, there's going to be transactions costs, whatever. But at every point in time, we're going to know what the expected return is, what the risk is, what your risk aversion is. And we'll be thinking about that. We might not change your portfolio every day, every month, every week, every year, but we're going to always be thinking about that. And that's how we're going to come to it. We're not going to give you a portfolio that's based on that's based on some assessment of your risk aversion, but has nothing to do with prospective returns.
I completely agree. I will be surprised if we see a valid criticism against that in the comments. I think you are correct, and it's a great point. The last big bucket I also want to dig into here is just around correlation, diversification. You mentioned a couple times here about the importance of you don't want to be taking idiosyncratic risk. You want to be taking market risk and be compensated well with the correct risk premium for that. But yeah, underline that idea of idiosyncratic risk is this idea of effective diversification. And I would just love to hear about your perspective on that idea of diversification, because I think what happens a lot of the time is when people go down the route of index investing, pretty quick they'll end up in something that is, perhaps just like a NASDAQ, market cap weighted index, something of the sort, which, yes, you're owning a lot of different companies, but their correlations are actually all very positive with each other. So, you start to wonder, how much of that idiosyncratic risk have I actually diversified out? So I'm curious about your perspective on what does good diversification actually look like?
So, yeah, I mean, I remember a long time ago, I was talking to my mom and I was like, Mom, you should get into these ETFs. They're very diversified, buy VTI, it's the whole US stock market, buy VXUS, it's the whole non-US stock market. It's good, they're really good. They're low fees, they're tax efficient, whatever. And she was like, okay, yeah, I'll do some of that. And then, after a while, a couple years went by and I looked at her portfolio and she was like, look at all the ETFs that I have. And she had like 20 different ETFs. She had, the energy ETF, a utility ETF, this, all these different ETFs. And I was like, why do you, and she's like, well, you told me to get ETFs, but so as you say that, that we can get into that we can own 100 different stocks in an ETF and not have as much diversification, as we can get. And so I think that the right amount of diversification is really the maximum amount of diversification you can get at a low fee. So, I would just keep diversifying as to the maximum extent that at the margin I can keep doing it at a low fee. So if it turned out that like the S&P 500, this is not the way the world is, right? But if the S&P 500 had a fee of 3 basis points, and then small caps had a fee of 50 basis points, and then private equity has a fee of 400 basis points, like owning the S&P 500 and small caps and private equity, that's really nice. That's good diversity. I would like that diversification, but I won't go past the S&P 500. I don't want to go past 3 basis points. So I wouldn't own small caps and I wouldn't own private equity because the fees are too high. But if I could get those at really low fees, I would do that. And so the way of the world today is that you can own all the stocks for 3 basis points, large caps, mid cap, small cap. You got VTI, you have VXUS, whatever. You can own 15,000 stocks for 3, 4, 5 basis points. And I think that's the best diversification you can get before you hit that kink. Then there's a kink. After that, there's a kink that's like, okay, now you want this other stuff. And some of the stuff is at 30 basis points, right? So like, look, there's a preferred stock ETF out there, I think. I don't know where it is. Maybe it's 30 basis points. It's like, oh, you know what? That's probably not worth it anymore. There's very little diversification and it's 30 basis points. And then, now you're into private credit, private equity, where the fees are much higher. And I say, well, I like that diversification, but I'm going to stop there. So, ultimately, the systematic risks that are out there that we can get compensated for, the systematic risks are not just like equity beta risk, right? That there are these other risk factors, I believe, for sure. I mean, inflation sucks,
Yeah.
like,
Yeah. Yeah.
like
Yeah.
unexpected inflation is a terrible risk, but I can't see the compensation, so I know it should be there. The compensation for bearing inflation risk should be there. But if I can't see it, I don't want to just take it on faith, because if I can't see it, nobody else can see it either. And so how are we pricing it? Like, how is it getting priced? And, I think that with inflation risk, it sure feels like sometimes inflation risk is not priced into the long end of the curve at all. Or the risk premium for oil. Gosh, sometimes it really has felt, I mean, I don't know, but it's sort of felt like times, I just don't want to believe it. I don't want to just be a belief investor and not be able to quantify it. Like, I don't want to be like a risk parity investor that's like, oh, this is how it is. I just close my eyes and I just take this. Everything has a risk premium, and everything has the right risk premium. And I'm just going to invest in that, so that I have, in this stylized world, I have the optimal portfolio in the stylized world, and that's risk parity. And it's like, well, maybe that's the way the world is, but I want to see it. I'd like to see it. I want to be able to verify it and not just trust it.
Yeah, I think that's fair. I think just to maybe sharpen the answer, we could also contrast what you just said there against some of the more, I don't know, exotic forms of diversification. And, I'm almost might tie back to your attempts back in the day of the Yale endowment thing. But, when I think about other forms of diversification, whether it's, adding long volatility, for example, say, trying to hedge left tail risk and that sort of thing, or gold. And these days there's a lot of talk about debasement hedges and that sort of thing. Is there any place for those styles of diversification in a portfolio?
Possibly. I mean, let me start with an easier one, I think, which is like trend following. I think that, trend following has this characteristic where I think it has done and should do pretty well, in these really nasty markets. It seems to have a negative correlation with beta and all of that. And I like it, but it just isn't, I can't get it low cost and tax efficient, really, and so I like it, but again, and also I can't really verify what the expected return is. I think gold is a little bit like oil in the sense that it's a big asset, and it probably should have a risk premium, but it's hard to analyze what it is. But you could say, well, I think gold is going to appreciate in the long term at per capita GDP. At the growth of per capita GDP, that's going to be gold. So gold is going to grow. So maybe gold. Maybe the growth of gold is inflation plus a couple percent. And okay, I could use that as an expected return, and then it has these kind of nice characteristics that it's a bit of a safe haven. So I could see a little bit of that, but I just don't want to have a lot of gold. And so I'm not going to get a lot of, it's not going to move for me, it's not going to move the needle a lot, and it's starting to get complicated. And then, I think vol, I think gold from those three, I think gold is the one that's like the easiest. It's like super low cost, super liquid, got some nice characteristics, it helped a bit, but it just would help so little. And then, I'm kind of afraid a little bit of vol. I think that, that vol, like, what if people realize, people might very well just realize that vol is a hedge. And so now, now I'm just holding something that has a negative expected return, being long vol, it has a negative expected return, and it's hedging me. Well, I'll just have I'll just want less of the risk. Like, I don't really need the hedge. And there's no way, nobody knows any way that we know. There's no easy way to estimate the return of vol positions prospectively, right? We're back in this, I cannot estimate it. There's some people that might be able, like maybe Susquehanna can estimate it, but I don't even think Susquehanna can. I think Susquehanna just is running a market making business. So I would say that I think vol is just is like oil. I can't estimate the expected return. And if anything, I'd say, well, long vol, but who knows with vol? I mean, you just get these worlds where like the whole world is selling vol in these crazy structures, and vol is low. Is now being long vol has a positive expected return, and then other times, like who knows, what the hell is going on with vol, and so I just am not, I would rather just own less equities than start vol trading around it.
Yeah, that makes total sense.
I just want to be simple. And that John Bogle said, we think he said, the best investment strategy is the one you're going to stick with. And I think that's such a, maybe we're getting to the end of our hour together, like that's such a good thought that's something that I've thought about a lot, that I just want to follow something where I'm going to stick with it. And that means that the reason I'm doing it is not because it's had a good historical performance, but the reason I'm doing it is because it's like really resonates with me deeply as a way of investing. And if I can find that, whatever it is that resonates with you and other people, like if you find something, approach to investing that really resonates to your core, is making sense, and then you're going to stick with it, that's the best thing to do. Whatever that thing is, I think that's the best thing to do. But if you're going to do something only as long as it's working, that's not good, I think. I think that leads to underperformance because it's a kind of return chasing that creeps in.
Yep, I totally agree. I think that's a really nice way to wrap up this conversation. I really enjoyed it, Victor. Where can folks go if they want to see more of what you do at Elm Wealth?
Oh, thanks, Felix. I really enjoyed it too. So we've got the elmwealth.com website is like our main website where we have all of our research, the games. We have a coin flipping game, the crystal ball game. But then also we have an ETF, and that has its own website, elmfunds.com, elmfunds.com. But you could get there from the Elm Wealth website too, but elmfunds.com. And that has all the information around our ETF, which is a low-cost, diversified, dynamic index investing application. The ticker is ELM, and it's called the Elm Market Navigator Fund, or ETF. And so there's information there. But for all of our research and writing and stuff like that, there's more fun on the Elm Wealth website, but the Elm Funds. And then, I'm pretty active on LinkedIn. I tried to do some short videos when we put out some new research. And stuff like that. But the websites are really the main places.
Fantastic. Well, thank you again for joining For Guidance. Really enjoyed that, Victor.
Yeah, thanks, Felix. Me too. That was really good.